There are 6 companies that I think are so cheap right now because the market has overcorrected in a negative direction. And in this video, I'm gonna lay out what those stocks are, why I wanna buy them, and why I think the market is totally wrong about them. The first company is Zoom. Zoom traded at an all-time high of over $300 a share. Today it trades at $85 a share. That's like an 80% some drop. But if you look at the numbers, the company is more profitable today by a huge margin than it was when it was trading at all-time highs. Now think about this for a second. Why did Zoom have this big run up during the COVID era? It was because there was a story that everybody was gonna be working from home and using Zoom. That story turned out to be true, but it didn't have this continued surge of new customers at the same rate that it was in 2020 and 2021. But again, the story was true because the company acquired a ton of new customers and is way more profitable today. And those customers are not canceling. That means that the profit margins on this company are huge, but the price of the stock has come way down. Looking underneath the hood, this company produces $2 billion a year in free cash flow, but its market cap is $25 billion. That means that its free cash flow return is about 9%. That's the same that you would expect to get if you just invested in the S&P 500. And Zoom as a company is continuing to roll out new products and acquire new customers and manage their cash flow so well that it's one of the few companies that I have ever added to my watch list that has no debt. And it has about $8 billion in the bank on its balance sheet. So we're looking at a $25 billion company with $8 billion in cash and no debt and $2 billion a year in cash flow. To me, this is just one of those obvious picks of a highly profitable company that I want to own because I know it's going to continue to produce cash for years. And is it going to compound at the rate of an Nvidia or a Tesla? No, because it doesn't have a story behind it. The story is that it was a COVID stock and everyone's forgotten about it. But I look at the numbers and say, I want to own this thing for a very long time. Second is Novo Nordisk. You might not know that company name, but you know their primary product. It's Ozempic, the big popular GLP-1 medication that everybody and their sister is using. Right now, Novo Nordisk has fallen from a high of $140 to just under $60. That's a big drop. Why did it drop? It dropped because there are other drugs now that are competing with Ozempic. So it's not expected to be the hot girl at the dance in the pharmaceutical industry. But does that warrant a 75% drop in the stock price? If you look at the sales of Ozempic, they grow almost every quarter. That's good. And it's not like that's the only product in the company's suite. They have other drugs as well, and they're releasing more. I looked at the balance sheet of this company and I was like, okay, well, what if Ozempic sales went to half of what they are? Well, right now, the earnings per share on this company is $4 a share. So it's trading at about 14 times earnings. Okay. Well, if the Ozempic sales fell like 50% and the earnings per share went to $3 or $2, well, it's still only trading at about a 20 to 25 times earnings. Are the sales of Ozempic going to fall 50%? Are the sales of their entire portfolio going to go down? I mean, Ozempic still has the brand recognition of the GLP-1 drugs, and they're releasing more products as well. And they pay a really healthy dividend. So I see this as an example of a huge overcorrection. The market thinks, okay, Ozempic is not going to grow anymore, but it still sells a lot and it's still super profitable. And there's still other products being released by this company. So this is a perfect example of when the market overcorrects to a headline, but the underlying company is still very strong and very profitable. Third, PayPal, my favorite, top of my watch list. It's the biggest holding in my portfolio. PayPal traded at a high of $300 back in 2021. Today it trades under $70. This is such a cheap stock. They're trading at 10 times forward earnings. Are you kidding me? They produce cash flows of $6 billion a year. That means the free cash flow return is 10%. That means that if the company doesn't grow at all, but they maintain, then your cash on cash return is 10%. Okay, that would be sexy all on its own. But then if you look at what they're doing to grow the company, the new CEO, Alex Chris, came in a couple years ago and says, we got to make PayPal popular again. He said publicly, we know that PayPal doesn't have a good reputation, and they're making really good steps to release products that are good for business owners like me. And if you're not a business owner, you probably use Venmo. 50 million people do, and they just started monetizing this. So I see opportunities for this company to grow. I see a very healthy, profitable, growing company that is way undervalued right now. Another good example of when the market believes a story that is several years old. They're looking at the old story. They're not looking at the current story and the future. And that's why at these prices, I'm buying as much PayPal as I can handle. Next, United Healthcare. I'm not going to win any friends on this pick. We all know the headlines. They're bad. The CEO was assassinated and they were investigated for fraud. As a result of those headlines, the stock fell from a high of $600 a share to $230 a share. This was the stock that nobody wanted to own until Warren Buffett came in and bought a whole bunch of the company. That's a really good sign. That's, possibly an indicator that this is one of those stocks that has been overcorrected. It's too cheap. If Warren Buffett says this is too cheap, I at least need to pay attention. And now the company is getting back on track, and they're still super profitable, and they pay a very healthy dividend, and at these prices is trading at like a 13 times earnings. To me, this is a long-term compounder. In fact, it's one of the best long-term compounding stocks in the entire S&P 500. So if you ignore the short-term headlines on this and you look at the underlying financials and the long-term staying power of a company like this, it just seems like an obvious pick to me. Next, Bellring Brands. You probably never heard of this company. Have you ever seen this? Premier Protein? It's in like every retail store ever. And I really like the company. In fact, I started tracking the company because I bought so many of these that I was like, is this publicly traded? And then I looked at the numbers and I saw that they were growing 30% year over year. And I went, oh, those are really good numbers. But I don't like to buy a company when all the headlines are good and all the numbers look fantastic. I wait for there to be some big pullback in the stock. And if we look at Bellring Brands, they traded at a high of $78. And that was back in May of 2025. Today, it's trading at about $36. That's like a 50% drop. But the company is still growing 30% year over year. They're still releasing more products. And the thing that I like about this company is it's not just this brand. They also own other protein lines. And I like companies that make acquisitions in the same industry. So if they're going to continue to buy companies and they're going to continue to grow 15, 20, 30% per year and release new products, then I like it when it has a huge 50% pullback. So this is one of those companies that I know, I like, I track, and I wait for a pullback, and it finally happened this year. That's why it's in my top 6 most undervalued stocks. And finally, the number 6 most undervalued company is Kenvue. You're gonna love this one. You've probably never heard of this company, but you've heard of almost all of the products and brands that they control. They own Tylenol and Zyrtec and Aveeno and Neutrogena and Band-Aid and a bunch of other products and brands that you would recognize. Now, here's the cool part. Well, it's not cool for some people, but they're down right now because of Robert F. Kennedy. Okay, so you might have seen this headline that came out about there might be a link between Tylenol and autism. But is that gonna hurt Neutrogena? Is that gonna hurt Band-Aid sales? If the report does turn out to be true, it's very bad for Tylenol. But the rest of the portfolio is going to be fine. Now, here's the other thing I like about this company. They're a spin-off of Johnson & Johnson, which means that they used to be part of a much bigger company. Johnson & Johnson has a market cap of $450 billion. Kenvue, the spin-off, has a market cap of $35 billion. It got spun off so that the leadership had more room to grow this portfolio of brands. And it pays a really healthy dividend. And if you look at the track record of Johnson & Johnson, it's got a really long track record of increasing profits. And they also increase their dividend every single year. So if I look at the spinoff, the much smaller company, and its dividend and its profits, and the fact that it's being just crushed in the headlines right now, this is one of those that I think the market has overreacted to one story, but the rest of the company is going to be just fine. Okay, now I'm going to give you some bonus picks. And these bonus picks are companies that I like, that I would love to own, but aren't quite cheap enough just yet. So we can track these over the next few months or the next year to see if there's an additional pullback that makes them interesting enough to buy. The 4 bonus picks are Target, Southwest Airlines, Simply Good Foods, and Alibaba. Let's start from the top. Target just brought in a new CEO because Target has been victim of the go woke, go broke, and, people trashing their stores. And it doesn't have a growth story. So it seems like a weird company to put money into. But Target has consistently been profitable for decades. They've consistently had a very healthy dividend. And currently that dividend is over 5%. That's enough to get my attention. I also like that it's trading at only 10 times earnings. That means that if the company doesn't grow, it's gonna make its money back on your investment in 10 years. That's really good for this market. Now, the all-time high on this company is over $300. It's currently trading at about $90. The numbers look really attractive, but in order for me to be excited about this company, I've got to either see growth or an even cheaper valuation. And that's why I'm watching it, but it's not in my top picks just yet. Next is Southwest Airlines. Southwest Airlines had a high of about $60. Today trades in the $30 range. Southwest Airlines is historically the most profitable airline in history. They're incredible at managing cash. But since COVID, they have had a really hard time producing cash flow at the same rate that they did before COVID. Are they going to be able to get back on track? I think so. I think historically, this is a company that has proven that it can create loyal customers and manage cash extremely well. Now, currently, the stock is trading at about $30, which is about a 50% discount from its all-time highs. Here's the challenge I have with Southwest. They're an airline, and airlines don't tend to trade for very high valuations. So for this to be a long-term money producer for me, it's either got to show more consistent, healthy growth in their profits, or it's got to come down even more. So this is a stock I really like and I would love to buy. I just don't see all the upside that I see in all the other picks. So I like it, I'm watching it, but I'm not buying it yet. Next, Simply Good Foods. You might not know that company, but they own Atkins, Quest, and Only What You Need. These are 3 different protein companies that are virtually in every retail store in America. Now, I like this company because I'm familiar with 2 of the brands in this portfolio. I met the owner of Quest Nutrition, Tom Bilyeu, years ago when he spoke at one of my annual events for entrepreneurs. And I've always been a fan of the company. Now, I thought that once they were sold to a big company, I thought that the company was going to go to crap. I thought they would stop innovating. I thought they'd stop releasing new products, but that's not what happened. In fact, Quest continues to release new products and they're pretty good. And I'm seeing them pop up on the store shelves everywhere that I go. So I was wrong that the company would degrade after it was acquired. So that's interesting to me. The other company in their portfolio that I'm familiar with is called Only What You Need. It's a plant-based protein company. And I was an investor in this company before it was acquired. It made me a lot of money. Thank you, owners of Only What You Need. Now, the parent company of these protein brands has always been interesting to me because they only trade at a market cap of under $3 billion. That's cheap comparative to other stocks. So I'm watching this going, does this have upside? Are they going to buy other companies? Are they going to continue to innovate and release new products? I want to say yes. And I think that is true. But in order for me to feel really good about it, it's got to come down in price even more. It started to, but it's just not super cheap yet. And I only make an investment if I think something is stupid cheap. And that leads me to my last bonus pick, which is Alibaba. I own a lot of Alibaba. I see it as a bet on the long-term economy of China. And Alibaba just announced that they're kind of gonna make a competitor to Nvidia. If anybody can do that, it's Alibaba. Now, is the economy of China gonna be bigger or smaller in 10 years? I think it's probably gonna be bigger. Is Alibaba going to continue to invest and innovate over those 10 years? I think yes. They traded at an all-time high of $300. It came all the way down to $70, and I loved it at those prices. In fact, on this channel, I said that Alibaba was my #1 stock pick of 2025, and it's rewarded me with a 100% return. It has doubled in its share price just this calendar year. I am very bullish on Alibaba, and I think it's going to go to all-time highs and beyond. But I really liked it at $70, $80, $90, $100. I even bought more at $120. Now it's trading at over $160. So is it stupid cheap? Tough to say because it's grown so much. But I still own a ton. I would like to buy more. I just don't know that it's as undervalued as some of the other stocks on this list. So I love this company. I believe that it's going to be a huge grower over the next few years. I'm just weighing it against all of my other picks because I only get to pick one each month. So those are the 10 companies that I think are stupid cheap and way undervalued right now. These are the companies that the market has overreacted to. They have a story about these companies that I think is wrong. And I love when the market is wrong about the story of a company, especially when that company is profitable, growing in its profits, and has a leadership team with a compelling vision for the future. Now, my primary wealth building strategy is to start and own businesses that produce cash flow. And then I take that cash and I invest them into companies that I'm going to hold for a very long time. That is my wealth strategy. Build profitable businesses, invest the profits. So if you're an entrepreneur who is on that journey, subscribe to the channel and we can follow along for the next couple of years and see which of these picks were right and which ones was I just batch stuff crazy about. And let me know in the comments, what are you tracking right now? What do you think is undervalued? And what do you think of these picks? Do you think they're going to go up, go down? Which ones do you think I'm crazy about? Let me know in the comments of this video. I'm Ryan Daniel Moran with capitalism.com. Thanks for watching. I'll see you on the next episode.